Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basis of Section 962. This is some help for individual taxpayers who we've been speaking to recently over the past year or two, who are having a problem because under GILTI, Global Intangible Low Taxed Income, non-Subpart F income of their CFC they have to pay tax on it even though it hasn't been repatriated. So let's go through the basics here, okay? Under the Tax Cuts and Jobs Act, TCJA, was introduced GILTI. The acronym GILTI, right, I guess they think it's cute, right? GILTI, Global Intangible Low Taxed Income, but it's way more than that. It's not, you can't really just define it that it's not only intangible or low tax, etc., etc. What happens is certain tested income across the different CFCs, depending on any assets that a person has that may be able to reduce it, can become tested income which becomes taxable even before that money is being repatriated. So in a situation in which a U.S. person may have a controlled foreign corporation in another country, makes good income, not high assets in the company, like a services company, like a law firm or a consulting firm, may find themselves subject to tax on money that hasn't been distributed, similar to something like Subpart F income, but this is a new type of income. So what's the big problem, right? The main disparity is that for individuals, they're going to get taxed at their regular tax rate before they take it out. And since it's normally the foreign corporation that's paying the tax, or the U.S. individual can't claim those taxes as a foreign tax credit. If you're a domestic shareholder of a foreign CFC, well, they're all foreign, but of a CFC, then you're in for a treat because you get a 50% deduction on the income, and then you get to apply up to 80% of foreign tax credits. At the end of the day, you may not have any tax liability. So it's really unfair, and it came into effect in accordance with IRC 965, which is a one-time repatriation. And when you mix it on a pot and you spit it out, the taxpayer individual really gets the raw end of the stick. Section 962, no one really cared about until recently, right? The idea is a taxpayer elects to be treated as a corporation, taxed as a corporation. Who would want that, right? Two levels of tax, etc., etc. But then the tax rate dropped to 21%, and now you've got this GILTI. So 962 was used back in the day when the tax rate was way higher, so that individuals aren't paying more than corporate counterparts on that income, okay? Under the 962 election, the individual, it acts as if between the controlled foreign corporation and the individual, there's a domestic corporation. So basically they get the benefits of the 962 election. What does that mean? It means they get a 50% deduction, up to 80% of the foreign tax credits. At the end of the day, they may not owe any tax either. So depending on how many foreign tax credits, tax rates, the amount of income, etc., etc., it may be a good deal. A couple of things to keep in mind. Sometimes it may not be necessary. So it's important if you have one CFC with high tested income, but then you've got 3 or 4 other businesses that are losers, CFC, whether you did it by design or intention, or your business ain't going well. What happens is you can, if it's negative across all of them, then you don't need to make the election, because the election could be a pain, especially for taxpayers who are uncomfortable making these types of elections. If there's no foreign tax credits, then you may lose a majority of the benefits, because ordinarily the keep benefit, in addition to the deduction, is getting that the 80% foreign tax credit. So without that, what you really may be doing is just deferring having to pay tax, but you may not get a huge tax benefit from it. In addition, there's, as of now, the 8993 is what you do, is what corporations file. But if you are an 8993, an 8992 is what individuals file for GILTI. So then they may have to file the 8993. They may have to file the 1118 for foreign tax credits. While it's not written in stone yet, for the most part, that's what people are assuming you're going to have to do. So there is some legwork that needs to be done. It's not just as simple as making the election. And then, for people who are not comfortable doing that, it's important to kind of calculate the tax first before just jumping off and making the election. If you're out of compliance for things like foreign income, assets, accounts, and investments, there's various programs you can use to get into compliance. There's the voluntary disclosure program if you're willful or can't certify under penalty of perjury that you're non-willful. There is the streamlined filing compliance procedure, streamlined domestic, streamlined offshore. There's delinquency procedures and reasonable cause. We have lots of free information available on our main website and our sub-websites. You can always reach out, schedule a reduced fee initial consultation if you think it's appropriate. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your evening.